Welcome back to another weekly episode, guys. So, I hope you saw the two updates I gave out on Instagram specific to our markets when the correction began. If you haven't, then make sure you follow me on Instagram because these days I'm coming out with 1 to 2 minute kind of updates on days where I cannot cover an update on YouTube. So, in this particular video, we'll discuss 6 points that are impacting the markets in recent times and what has to be done heading forward because, quite frankly, the market has become quite challenging. Not that we did not discuss this earlier, but I think heading forward in the next 6 months, there are a lot of data points that can either make the market move really fast on the upside or on the downside as well. So, the first point is the Japanese market, whatever is happening in the Japanese market, the yen carry trade. I'll quickly explain this in layman's language so that you can understand. The second point is about the US market, the deep correction and the structure that is currently there in the overall US market setup. The third is about US economy. Couple of points I'll explain about fear of recession and unemployment data. Fourth and most important point, I think, in the next 6 months is the US presidential election. This, I believe, will be a make or break election for the market and for the world in general. Again, a couple of points I'll explain. Then our very own DII flow, which is the retail money and how it is saving the market every time. And the sixth point will be about Indian market, about leadership and what you should be doing. So the first point I'll cover is the yen carry trade. Now I found this beautiful image through all 21 and they had done a brilliant job explaining what this is. So basically the yen carry trade is, suppose you are an investor and because Japanese central banks had a policy of near 0% interest rate, you could borrow money in yen, then convert it to your own currency and invest that money in high yielding assets. So if you're getting loan at 1% and you're converting that money and then putting it in some riskier assets that will pay you something like 4, 5, 6%, then at end of the tenure, you can make returns here and then pay back the money, that is from the earnings, you make the repayment of the borrowed money. So this was basically the yen carry trade. Now, why things started to, go haywire a bit? The reason being that Bank of Japan raised the interest rates in the Japanese market. Now, because of that, always remember whenever you are borrowing a currency and it starts getting expensive, then the cost of money and the probability of you making a return, because currency movements usually cause a lot of volatility now, even in the crypto markets, in the stock markets, in the commodity market. So imagine you as an investor taking a hit here, then you will have to take a hit when you convert the currency back to yen, and then the cost of borrowing here has gone up. So this is actually the main reason why equity markets all over the world were very dicey and started falling a lot. In my opinion, I still don't think that the yen carry trade has completely played out. It will again come back a few weeks down the line, a few months down the line, because the more I started to research about this topic as to how many billions of dollars are out there or maybe more, I could not get a specific number. In fact, most of the reports that I read, the figure is roughly 300 to 400 billion dollars, and that is also a rough estimate. So you don't know what is currently happening on that front. The easiest way is to track the Japanese market. The second point, that is when we come to the US stock market structure, within which I'll also cover the Japanese stock market structure. What you see here is simple candlestick chart with 50-day moving average. Look at the fall that happened in Japanese stock market from 42,000 to 31,000, and now we are seeing some retracement. There are a couple of things here. There is a gap here, the 50 DMA resistance here. So you've got to visualize how things can play out. It's highly unlikely that in this scenario we have a V-shaped recovery and we hit 43,200, which means we'll remain in this broad range till the point market gets further clarity. And if there is more skeleton in the closet and the Japanese stock market after retracing to 36, 37 or 38,000 start falling again, it's going to drag the entire global market with it. The next chart is understanding what is happening in S&P 500. Again, this is simple 50 DMA. We have broken below 50 DMA. There are two gaps here. strong gaps created on the chart. Currently, we are seeing some retracement. We can go even higher and touch something like 50 DMA, retest it out, form a range, and then you got to see what happens. See, we are developing a assumption that no matter what happens, India will remain unaffected. It's mainly because of the domestic inflow, and I'll come to that point at a later stage. But remember one thing, and this is something I spoke midweek on my Instagram update also. Just because India is not falling today, it does not mean India cannot fall tomorrow. So don't believe in this notion that now we are completely decoupled with the world and we have so much of money coming in through the retail network that any bit of negative news in the world we'll be able to digest. This is not true. We are not trading at cheap valuations. Yes, I definitely believe this, that whenever we get an ugly fall in the market, that fall will be bought into because FIIs largely are under-invested in our market. The DII inflows are so strong that money has to go somewhere. So I definitely believe that. But we are not in a position today where we won't get impacted by what is happening in the world. That is why, to keep things simple, in your weekly analysis, put out S&P 500 data 50 DMA and Japanese Nikkei 225 index 50 DMA, and then study what is happening. And both of these indices are well below the 50 DMA as of now. Now coming to the US economy. This is again a wonderful chart I found from USA Today. So the first quarter economy growth in terms of GDP fell to 1.3%. Now it is still in the positive. The media commentary that I was hearing was this is still positive, economy is still growing. But if you compare it 1 year ago, it was at 2.2%. So there is definitely some amount of contraction that is currently happening in the economy. It's not that this data was not anticipated, but always remember, whenever inflation is high, growth should support that number. If you look at India today, our inflation is somewhere around 5%. Look at our growth numbers. That growth is currently supporting the inflation. Even if you don't believe the inflation data that the government puts out, let's say government says it is 4.7% and you think it is 6%, still the growth is able to counter that. So in the US, if inflation keeps remaining high, which it is, and it's going to be a focal point in the upcoming presidential election, with respect to that, growth definitely is slowing down. What spooked the market this week was also the jobless, that is unemployment, data that came out. If you look at this from October 2023, the data has steadily risen from something like 3.8% to something like 4.3%. Now, whenever unemployment rises in the US with high inflation and lower growth, that usually does not bring good news for the stock market. So you have to keep an eye about what is happening. We are no longer in the macroeconomic kind of a scenario that we were 6 months back. We are no longer in a global market environment where all of the indices were heading higher, forming a beautiful higher high, higher low structure. The trends everywhere have been distorted. Yes, it's possible that we again start trending higher. But in the very short term, as I spoke in my Instagram updates, it won't hurt to be a little bit cautious over the short to medium term. If you're a long-term investor, SIP investor, systematic trading plan kind of a player in the market, nothing matters to you because you can gradually accumulate as the volatility comes about in the market. Now, next I come to the US presidential election. This time around, it's not that elections are not important. Even our elections were important, and you could see when the market was not sensing the ruling government coming back to the power with clear majority, we had a correction, intraday correction of 15 to 20%. Stocks were down 25-30% also. In the US market currently, the fight now is between the Democrats, the candidate supposedly is Kamala Harris, and Republican candidate that is Donald Trump. Now, Donald Trump has a track record in terms of stock market, in terms of economy. Yes, he mishandled COVID. Had he not mishandled COVID, he would have again come back to power with landslide majority. The reason being, in his regime, and again, this is only about stock markets, the markets were doing well, economy was doing well, inflation was at record low levels, and on the whole, the American spirit of doing business was was really strong. Now, the next 4 years have been challenging because of COVID. There was a lot of cash distribution that happened that brought about ugly inflation that is still not going away completely, and that was led by President Biden. Now, the vice president was Kamala Harris. Largely, the markets would see policy continuation if she were to come back to power. She also remains one of the most unpopular vice president that is currently there in United States of America. Historically, also, I think she's 11th, placed 11th out of 13th in terms of vice president rankings. So she's not that popular, but the ecosystem around the Democratic Party is always difficult to defeat. So, the odds, and if you look at the polls, odds are still in favor of Kamala Harris becoming the next president of the United States. And I think if this were to happen, it's not going to go down well with the stock markets. At least that is what I will tell you. Plus, currently, the ruling government in the US has failed to curb what is happening across the globe in terms of geopolitical disturbances. So it's going to be an interesting play here. If Donald Trump comes to power, he's already made his point clear. He's going to make a deal between Russia and Ukraine. It's going to be positive for the stock market. He's going to sort the issue between Israel and Iran. Again, that is going to be a strong point for the stock market. Whereas the Democrats currently, the policy on global war, their record recently, I don't think America can afford another 4 years of war or geopolitical disturbances. For that matter, a lot of other countries won't be able to afford that either. So it's going to be very interesting, the presidential election. I think the next 3-4 months are going to broadly decide the trend for the next 2-3 years as well. So let's see how this particular thing plays out. Now we come to the fifth point, which is the DII inflow, which is the retail money that is coming in the market. If you look at the staggering growth that is seen in the kind of money that is coming, I mean, it's unbelievable. Look at the SIP amount that comes in, and this is just SIP data. 20,000, 21,000, close to 21,500 crores. I'm sure the July number would be somewhere above 21,500 crores. And the way we are heading, by the time we reach next March, that number will be closer to something like 23 or 24,000 crore. Now, this money has to go somewhere. And that is one of the reasons you're seeing that every dip in the market is being bought. And I don't think this is going to change. So the kind of corrections that we are getting is a swift V-shaped kind of a fall in the market, and that eventually gets bought. I think if the US markets start running into a lot of problems, then India will face both time and price correction. And this time around, even foreign institutional investors would like to get into our markets. The simple reason being, in terms of relative strength and given the scale of our market, India is the best performing equity market hands down. So if you're a long-term player, wait for that dip, and dip will come. There's been no equity market rally in the world where you don't get entry opportunity again. And I'm not talking about V-shaped fall and one-day recovery kind of an opportunity. I'm talking about a systematic time and price correction, which our markets will also go through. Bring you back to this chart that we covered a couple of weeks back, which is the choice between risk and reward and momentum. The good news is that a couple of more sectors have been added to the risk reward bracket. So Nifty Bank and Nifty Metals are always there. Now Nifty Realty and IT and FMCG are also added here. IT and FMCG in the short term need a bit of pullback, but Realty, Metals and Nifty Bank have already pulled back and are below 50 DMA. You have to ensure that you start building positions only when these sectors start moving above 50 DMA and you see proper structure on charts. For IT and FMCG, they are in strong stage 2 structure. Whenever they see retracement closer to 50 DMA, that would be a good time to start looking into the space. Now momentum, where is the momentum? Momentum still is in CPSE, in auto, in digital India, in engineering and manufacturing. In this, you should also include the defense and railways theme also. So the play here in the market in the next 6 months is tricky. It's tricky because if you look at the risk reward space, then the structures here are not great. But if you look at a momentum phase, yes, the structures are still fine of all of these spaces, but there is no risk reward. So on either side, you will have to bet whether you're a momentum player or a risk reward player. If you're a risk reward player, your choice is Nifty Bank Metal Realty, clear high beta bet, plus some diversification into IT and FMCG. If you're a momentum player, then your choice is pretty clear. It's CPSE, Auto, Digital India. I haven't included pharma and healthcare, which by the way are the best performing sectors currently, mainly because I don't understand those spaces and I don't trade it. That's why I haven't included it. But otherwise, this is the choice that is in front of you, and based on who you are, you should be deciding in which sectors to participate. Remember one key rule: if price of a sector is sustaining below 50 DMA, do not attempt to trade it. Let it come back above 50 DMA, let it form a proper base on the chart, and let it give you signs of breaking out. Only then go behind the trade. Now let me come back to the Tata Motors example. 3 weeks back, I'd given you an example when Tata Motors was staging a breakout. This is a weekly time frame chart, so obviously the daily data is not here. But when the chart was giving a breakout and the auto sector was suggesting continuation, the way I had asked you to participate, not in this counter, but whatever counters you like, is through systematic buying, slow and gradual accumulation. And I'm glad the chart has played out this way. It has not had a recovery, from 1100 to something like 1600. The reason being, had you bought everything here the day breakout happened at something like 1050, look at what you would have had to face. Initially, the price would have moved in your favor, then fallen to something like 1000 again. Instead, if you had a systematic approach in the market, you would have bought at 1050, at 1100, at 1125, at 1175, again at 1125, at 1100, at 1070, at 1025, at 1000, and then again on the way up. The point that I'm trying to make is that this market is a SIP, STP kind of a market. If you want to make one-time bets or you want to pyramid into positions, then look into ETFs. But when it comes to stocks, prefer accumulating stocks over a period of 16 weeks or 32 weeks or even 48 weeks. Slow and gradual approach in this market is going to be very beneficial because you just don't know from where volatility will come, and that would actually shake you out of your positions. The only way to counter volatility in the market is to gradually accumulate stocks. So now I'll give you a key summary of what is happening in the market currently. First, if you look at the weekly charts are still looking fine. Slow and gradual accumulation will work. You will see that majority of sectors have actually printed a long tail candle. Global markets. It's important to recognize that the global markets have changed significantly. That is why you will need to monitor S&P 500 with 50 DMA, Nasdaq with 50 DMA, and Japanese index with 50 DMA. If you want to be able to analyze what is happening in the Middle East, just follow the same in terms of crude oil chart, put 50 DMA and see what the price is doing. Number 3, fund flow. The good thing for India is that the fund flow remains strong, but it does not mean that we are not prone to corrections and sharp reversals. This is something you have to forget. India can correct. If global markets get into trouble, India will correct. I'm making this point strongly because through media you get a sense that India just cannot fall and every dip will be bought. Don't fall for this. Risk reward. This only exists in sectors that don't have ideal structures. So Nifty Bank, Realty, Metals, they actually don't have proper structures for a trade, but risk reward only exists in that pocket. So a difficult aspect or a difficult judgment that a trader has to make here is whether he has to be a momentum player in the market or a risk reward kind of a player in the market. Last, volatility. Volatility is set to expand even from here. Now, global markets are retracing back on the upside. Very soon, you'll start hearing that things have gotten normal, everything is fine, and those kind of things, but keep a tab on volatility index. If volatility index starts to spike again, then you never know what is coming in the market. It's mainly because there are 2-3 important events that are lined up in terms of Fed rate cut. They've already announced they want to do it in September. US elections are coming up. In September, we are going to have presidential debate of the candidates. So it's going to be a volatile kind of a quarter heading ahead. It wouldn't hurt at this stage to be a little cautious. Whatever you want to buy, do it through SIP, STP way only. With that particular way, you will at least get rid of volatility or minimize it. Plus, most importantly, you won't get shaken out of your positions. So thanks for watching, guys. I'll see you in the next update. Take care and be safe.